How much as a first-time home buyer do I need for a down payment? Now, the answer, and this caveat's going to apply to every single answer I give you, like ever. Whatever you're bringing to the table as an individual matters. There's going to be a lot of little things that can have outsized impact on the options that are available for you. But suffice to say, generally speaking, as a first-time home buyer, the first thing I would think about is splitting your options into different programs. Now, the kind of gold standard loan, if you've got the credit to qualify for it, it's very likely going to be your best option, is a conventional loan backed by either Fannie Mae or Freddie Mac. Conventional loan, you can, as a first-time home buyer, you actually have special access to a 3% down option with a conventional loan. If we're going into the world of FHA loans, which is really, I almost hate to say it, it's kind of a second choice for me because it's not really the best program if you've got the credit to qualify for conventional in most, but not all cases. FHA requires a 3.5% down payment. Now, if you're a veteran or a qualified person for a VA home loan, this is available with 0% down, whether it's your first time buying a house or not. If you're buying in a rural area that's covered under the government's USDA lending program, you can qualify for potentially a 0% down payment in that case, regardless of first-time home buyer status. Now, it's worth pointing this out as a first-time buyer. Those are, kind of the main percentages that you need down. 3% with conventional or 3.5% with FHA. You may qualify for down payment assistance. Now, the last video I did was on a Missouri-based program called MHDC. Your state, if you're not in Missouri, undoubtedly has something similar. There's going to be a whole bunch of options for you to look at as a first-time home buyer for, I don't know, it's probably not the right way to say it, but the free money programs. Now, a lot of times the free money programs are not exactly free money, but you very likely will at least have a chance to access either a first-time home buyer grant, which would be great, a first-time home buyer loan, where if it works like the Missouri program, you essentially get a silent, forgivable second mortgage at a 0% interest rate, which ends up covering that minimum down payment required. So suffice to say, you don't necessarily need a giant pile of money to buy a house. Next up, how much house as a first-time home buyer can I afford? This is a tough one. If I'm talking to an individual client, it gives me a little bit more scaffolding to work this question off of. But I think this is the most important place to start. Before you even run any mortgage calculators at all, and I'm serious about this, I don't want you to even open a mortgage calculator. I don't want you to start poking around with numbers, because before you can even worry about the mortgage side of things, where I find people are a little lost is they don't necessarily know in these early stages you're thinking about buying a house. I don't blame anybody for not knowing this right off the bat, but it's something I definitely recommend getting an answer to. I think, to be honest with you, you got to take a very, very, very close look at your money, which is something that nobody wants to do. I'm going to use that word. It's kind of a profanity in some circles, but you may have to budget. And by budget in this instance, I mean, go through your bank statements for a period of, 6, 12 months. Take a look at the money that's going in and the money that went out. See if you can identify what your actual expenses look like per month, what your actual net income looks like. If you got a $70,000 salary, we always quote the pre-tax number. Obviously, you really need to zero in and get a firm understanding of what's going in and what's coming out every month. The goal of this analysis is for you to determine, I think, what is the most critical, important number to get in place. And only you can do this. There is no rule of thumb that can do this. There's no 38% of this or 24% of that can do this. Only you can determine how much per month you can comfortably afford for a mortgage payment. That number is the number you got to start with. Once you have that number, we can, of course, make sure that you are going to qualify under the mortgage guidelines for a payment at that level. But that number is really what's going to drive what you should be looking for, what you should be looking to take on. And we can do all sorts of math for you. If you come to me and say, well, I think I can afford $2,000 per month comfortably. We're going to take that $2,000 and we're going to kind of backwards engineer the price point. How much do you have to put down? We'll run all the math and we'll figure out what that translates into. But what I find for most people that I talk to is when I ask that number, I mean, they're kind of just spitballing with me. Well, I think I can afford $1,600 a month. Can you? I'm not going to be the guy to tell you that because I don't know your lifestyle expenses. I am not a personal finance coach. I'll point you in the right direction on some things and I'll certainly answer questions. But I actually think it's really important if you're going to take on ownership, you need to show some leadership over your own financial life. And so that's where I would start. Come up with the number that you know you can afford, and let's work the math on the back end to figure out the price point that makes sense. Next up, this is a big one. And this one really makes me sad, to be honest with you. Will my student loans prevent me from qualifying for my first home loan? The honest answer is here, maybe. The devil is in the details, as with all things mortgage related and everything else in life. There are a lot of people that carry around an assumption that because they owe like a really scary amount of money to the federal government or to the loan service or whatever, they think, well, I owe $200,000 for my undergraduate and my master's degree. And they're just carrying this around as this kind of psychic burden in addition to obviously the practical burden of owing that kind of money. But they just kind of make an assumption. Well, they're going to see that I owe $200,000 on student loans. Like they're never going to give me a loan. Here's the funny thing about that. Student loan companies, I got to be careful because nobody in the world would defend student loan companies. Would not be a popular thing to say. I'm not exactly defending them by saying this, but your payment options, at least in my experience, working with a lot of clients and their student loans, working with some of my own student loans, my wife's student loans, etc. The payment terms are pretty flexible. What we are caring about fundamentally when reviewing the impact of those student loans on your ability to qualify, really the only thing we care about, it's not the balance. The thing that we care about is the payment. The monthly payment on your student loans is solely what will impact what you can qualify for on the mortgage. A very common thing that we'll see, I'll pull a credit report. Somebody owes $200,000 on their student loans, and they have not yet entered repayment. Well, in this instance, we don't have a monthly payment on the credit report to work with. So what we use in this instance, depending on the program, is we're going to take that balance. We're going to multiply it by either 0.5%, which you can do the same mathematical thing by dividing by 200, or 1% of the balance. You take that number and that becomes effectively the stand-in for the monthly payment on the account. Well, what's a scarier number? You owe $200,000, or if we put you under a program where we can use 0.5% on that for the payment, or we're thinking about this in terms of $1,000 monthly payment. Now that $1,000 monthly payment, it's a big number. But again, what matters with that $1,000 is how it stacks up with all your other debt payments. If you're somebody coming to me and this is like the only debt you've got, well, I'm going to sit here and tell you $1,000 a month in terms of consumer debt to service that debt on a monthly basis, it's probably less than average. And then it's going to be a matter of taking a look at your income and just determining, like, your income is, I don't know, I'm going to make up a number. Let's say it's $10,000 a month. You have $1,000 student loan payment. And I don't know, let's say $1,000 in other debt expenses, credit card payments, car payment, whatever. If you got $10,000 over here in income and $2,000 in debts, you've got room for about $2,000 to $3,000 on the mortgage payment and still be at an appropriate debt to income or an approvable debt to income ratio limit. Bottom line here, do not assume that you have student loans and therefore you can't qualify. What you have to do is kick the tires on the math, figure out what you're actually dealing with, figure out how it relates to your overall debt ratio, and then we can make some firm determinations as far as what impact that has on your mortgage approval. Next up, this is a good one. I just started a new job recently. Do I need to be on this job for a certain period of time in order to qualify for a mortgage? The answer, as you might imagine, really depends on the details. If this is a job that is a W-2 salaried-based job without variable income components, that is income that the industry looks very favorably upon. And believe it or not, even if you haven't started that job, we could in theory get you closed maybe somewhere in the range of like 60 days prior to when that job starts. Now that's a kind of a pretty loose underwriting standard in my mind, but the rules will allow it. That's kind of the gold standard as far as stable options. If it's a salaried job, we're going to be able to use that income right off the rip. If the job is not W-2, if it is a 1099 contractor position, then all of a sudden you're in the world of the self-employed borrower. And the way that the mortgage rules are written, it's almost like they don't want you to get a loan. I should be more fair. What the guidelines really want for anybody that is self-employed, and we're going to define that in this case as being on a 1099 or running your business. If you're self-employed, the mortgage agencies that write the rules, they really want at least 2 years of that activity and 2 years of tax returns to go off of in order to determine like what kind of stable income you have. So that if you're just starting a 1099 position, there are some specialty programs in the world of non-QM loans that we're going to take a look at in your case. But in terms of standard options, conventional Fannie Mae, Freddie Mac loans, FHA, you're probably sunk. You would need to establish, at least ideally a 2-year history, but maybe you could get away with a 1-year history of that income before we'd be able to deem that income reliable in order to support a mortgage approval. Hourly income. If you have just started a job that's an hourly income job, this does open a can of worms. And I'm really going to tell you, you're in a category where you absolutely need to be talking with somebody like me. Hopefully it is actually me, but somebody like me to assess your circumstances and to figure out whether or not your income is going to work. One of the things that the mortgage agencies have done very recently is they've really turned a really nasty eye toward any kind of variable income. So if you're on an hourly job and it's not like an absolute set number of hours per week, we're not looking at pay stubs that just say 40 hours, 40 hours, 40 hours. If instead it's 31 hours, 36 hours, 39 hours, 29 hours, if it's variable and it's hourly, you're going to need to have at least, at the bare minimum, a 1-year track record of that job in order for us to look at what the average income is on that job per month. So really the only instance here where you don't really have much to worry about at all in terms of a new job and qualifying for a mortgage based on that new job is if it's a salary-based W-2 position. What is the minimum credit score to qualify? I'm actually not going to answer that. What I'm going to tell you is that your credit score, there are minimum credit scores. There are minimum credit scores for various loan programs, and I can sit here and tell you exactly where all those dividing lines are. What I'm going to do instead of directly answering this question is say this. Regardless of where your score is, even if you were to meet the minimum credit score of a particular program, maybe just barely, if you don't want to lean on that. You don't want to rely on that. Because at the end of the day, the actual full evaluation of your mortgage, it's going to go beyond the credit score. It's going to go into the content of the credit report itself. And you could very easily have a credit score that meets the minimum criteria, but I don't know, let's say you've still got some derogatory accounts out there. And maybe there's some decent balances and collections or something like that. That's a red flag, and that's going to potentially put you in a spot where you're like, I got the minimum credit score. I'd like to get my loan. And we have to say, like, no, you can't. Credit issues in general, if you've had a really clean period of the last 12 months, you stand a very strong chance of being in a spot where you can qualify. I'll just say that as a kind of a general principle. If you've got credit concerns and your plan is to purchase a home, again, the advice here is going to be universal for all these questions. Get with me in advance. Let's talk about it. Let's figure out what needs to be done to get you there. Last question for today. I've been talking probably for too much already. I make money in the gig economy. How will this impact my ability to qualify for a loan? Well, this probably doesn't come as a surprise with our conversation on variable income in general. To be dead honest with you, I think the phrase gig economy is probably considered a swear word over at the offices of Fannie Mae and Freddie Mac. This type of income really falls into a category that is kind of by definition unreliable. And therefore, again, the principle is going to be this income, whether it's Uber or Lyft or I don't know, is there like a special one for the grocery delivery? I can't remember. Grubhub, I don't know. These various gig economy type jobs. you're really a self-employed person in that role. And that's how we're going to view it in terms of the mortgage guidelines. So if you've been supporting yourself in the gig economy, you may be able to qualify off of that income, but we got to have a track record. And what unfortunately I see a lot of is like people just started doing this to supplement their income 6 months ago. It's probably somebody that we're going to look at it, even if you're killing it, driving the drunk people home for Uber late at night and getting the best fares and whatever. It doesn't really matter unless you have that track record. That's really what matters. Well, I hope this kind of random batch of questions and my answers to them gave you some food for thought. There is no replacement for the conversation with me in terms of value. We're going to identify what you need to work on if you need to work on something. If you qualify right out the gate, let's figure out exactly where you should be on the price point to make sure that you're getting the right mortgage for you. Call me, text me anytime. Love to talk to you. Have a great day.